Hey folks, how's it going? Welcome to another episode of, well, we're always bringing you value, and I'm glad you guys were able to make it. I'm Evan Saint-Gerard, your host, your moderator, and we have a slew of top professionals here on the panel to discuss. You're thinking about selling for many reasons, and you want to know how you can sell, get that taken care of, and also make sure you put some money in your pocket and the best value there is. Again, I'm Evan St. Gerard, so we're gonna have our first speaker speak today, and this is Dean. Dean, introduce yourself, please, to the audience.
Hi, everybody. My name is Dean Graber. I work with Evan St. Gerard over at Keller Williams Realty Landmark. And we're going to be talking a little bit today about selling your property, what's involved with that, and what you can do with the money for this property. And honestly, let's be honest with this. Anyone can basically list a home and put a home on the market. But you have to decide for yourself what your plans are. If you're teetering on should I sell, should I not sell, should I move, should I not move, there's a lot of different options and a lot of different reasons that people sell their home these days. A lot of times people are growing up in a home, and sometimes it presents a kind of situation where you might not be all that comfortable in the home, whether it's climbing steps, taking care of the maintenance of the home, and items such as that. And it might be a better option for you and your family to downsize a home. Now, when you're doing something like that, I know that it's real important to have a good team with you. That's why we have the other gentlemen that are here today that can share some of their expertise about how that can happen and how they can all help you make the most out of this. As far as the real estate role with this, I know a concern is that people don't want to move until they know where they're going. And that's why we sit down and talk, lay out the options. Fernando is here today also to share with you if you need additional financing or new financing to make that move happen. And we also have gentlemen that are here that can share with you how you can take the equity out of your home and use it for other investments as opposed to just sitting as equity in your home. All right. And you'll have growing equity in your new home. Possibly there's some other channels to enhance the equity, to enhance the return on the equity that you do have so that you have a safe, comfortable retirement. Now, some other people might just be thinking about selling in the next 3 to 12 months, let's say, because they're moving out of the area and they're moving to another area. We can help you with that also, but a lot of this starts off with hiring the right people and talking and having a real open conversation about what your needs are, what your plans are. So when we're working with a family to sell their home, I understand there's this piece of real estate and that's here. Like I had mentioned a moment ago, anyone can put a home on the market and sell a home per se. But we want to make sure that you get the maximum return on the equity that you have in the house, that you make the right decisions with that equity so that you can have a safe and comfortable retirement or safe and comfortable enjoyment, and affordable enjoyment in your next home. And we try to alleviate, or we will, by listening to you and asking a lot of questions so we can learn about you as much as we learn about the home. It's really mostly about the individual that's moving. But whatever your situation is, whether you're moving up, whether you're retiring and moving down, whether you're changing to a new state, for me and for Evans, it's really about the conversation so that we can learn everything that would be helpful for us to know about you for this move so that we can make the right choice for you. All right. And with that, who's next? I want to see if we can have this go around a little bit now. Gentlemen.
Anthony, I believe you take the reins next on this one.
No, Fernando is supposed to go before me.
So Fernando, you're next.
Here. Hi guys, my name is Fernando Lopez. I'm a loan officer. I work for United Mortgage. Actually, thank you for inviting me to this seminar. As a banker, actually, we are part of the transaction if you want to do the move, because we are the financial part that is going to help you out to do the next move. It's important, actually, that before you do this move, you try to buy another property, sit with the banker, of course, because you're going to buy in cash, you don't need us. But if you're going to need money from a lender, the lender have to know your situation. We do a lot of transactions of these, people that buying at their sell. They sell and they buy. But most of the time, these people, they are scared to do the move because they don't know if they're going to be able to buy the next property. And that step is when I get in and I can explain, the different options, that they have it with different programs. If they want to show income documentation, we can do this as a conventional loan through Fannie Mae to Freddie Mac, or we can use no conventional, financing that will be like a non-QM loans that they don't follow the Fannie Mae or Freddie guidelines. It could be an stated income loan, okay, when we don't have to show pay stubs, W-2s, taxes. We just can do also a P&L. If you are in business, let's say that you are a business, you can use your, a P&L prepared by your CPA or tax preparer. Or if you want to use bank statements, to show that the deposits coming in, we can do, bank statement program, 12 months, 24 months. Also, we can do DSCR loans, debt servicing cover ratio loans, that where the income of the property help, cover the mortgage payment. And actually it's zero documentation presented at that point. The most important in the DSCR loan is just that your credits must be good. That the property that you're going to buy must be, the proposal rental of that property must cover the mortgage payment. The most popular that we are using right now is with self-employed people, the P&L program. That's very easy, simple, forward. It's one page. We don't need much. And the rates are very competitive now. And always my suggestion, guys, if you're going to do this move, sit with a banker, because you need to know if you're going to need money from a lender. You need to know what program you're going to qualify, or whether the lender can put you for, the next financing. It's very important also that you got, I know when people want to sell a house or get retired, you need to take care about your credit payments, don't get, late, because now when you're going to get the next move, it's like I just start from zero. Okay. We have to verify everything. Sometimes, guys, you need to understand, if you go for non-qualified mortgages or non-QM loans that they don't go, with income documentation, like a taxes, pay stubs, W-2s, the lender really care about the credit, okay? Because that's the only thing that they're going to measure, your repayment ability through your credit report. Because if your credit report is mixed up, trust me, investors don't touch it. But we got a lot of available programs now that we didn't have before, and it's good because one way or another, we make people qualify. If you don't qualify by that time, we can give you the to-do list, to follow up, to put you on track. Yeah, could take 2, 3, 6 months, and you are in track to buy the next property. We do the homework with you. We do the follow-up. We need to fix credit. We do all that steps. That's what I say. The most important thing, guys, you need to see with the lender before you do this move too, if you want to buy or get money for the next property through a bank. Okay, thank you.
And next up is Anthony.
Hello, everybody. My name is Anthony Curcio. I'm a real estate attorney with Curcio Law. It's my law firm. We deal in all aspects of real estate law. I'm going to be discussing real estate transactions today, mostly from the purchaser side, and kind of what to look out for when you're going into contract, there's, some of the important provisions that are in the contract. There's some that are, boilerplate legalese, and other ones that can affect whether or not you're able to purchase the property, whether you're able to pull out of the contract, and so on and so forth. I'm also going to talk about a little bit about title insurance and then the closing process as well. Let's begin with the contract. Once you've spoken to Evantz and Dean, and Fernando's gotten you qualified and you found the house you want, you put in an offer. Once your offer is accepted, next step is we're going to go through the negotiation process with the contract of sale. These may seem like minor things, but they're actually very, very important. Buyer and seller names have to be correct. It seems simple enough, but when it comes time to run a title search and the names are not correct, that could present all kinds of problems. There could be judgments that are brought up that are not exactly yours. They could be somebody else with the same name or has the same middle initial. I mean, there's a lot of confusion that can come about with that. Same thing with the property address and description. Make sure they're accurate. Make sure the section, block, and lot is accurate. Those seem like very simple things and like no kidding, but you'd be surprised. A lot of other things that are discussed when the house is sold is the personal property that's going to be left behind. When you're dealing in the purchase or sale of a residential property, there's a lot of emotions involved, and it depends on, why they're selling a property. It could be, the death of a parent. It could be a divorce. It could just be you want to move up into a better home. But a lot of people get sentimental about things that are in the property. And if you want to keep something that normally is attached to the house, like a chandelier or something that has some kind of value, that has to be put into the contract as well. I've seen people put things as crazy as like a bush. They want that torn out and brought to the next house because it was their mother's, or they, just had some kind of sentimental value to it. So there's a lot of there is personal property that people do take. And if you want to do that, you got to get that out right away into the contract and make sure that's expressed. Again, make sure the purchase price is correct and created the correct down payment, because this down payment is going to be held with the seller's attorney. It's going to be your skin in the game. Once we go to contract and you deposit that, you give the deposit to the seller's attorney, he's going to hold that in escrow. That's going to get credited toward your purchase price at closing. This is also going to it's going to be you'll see it in the contract. It'll come off the purchase price, and you'll have a remainder that you have to pay at closing, which will consist of normally your mortgage and then some cash that you have on hand. In regards to financing, most people nowadays need a mortgage. The price of houses in New York are pretty substantial. If for a decent home in any area, it's usually between, over $700,000. A lot of young people don't have that kind of money laying around, so they have to take out a mortgage. When you are taking out a mortgage and you're going into contract, there's something called a mortgage contingency clause, which is in the contract. Which this does is it's an out for the purchaser. It allows them to go forward to apply for financing. This has to be done within 45 days of going to contract. If they are denied for some reason that is not the fault of the purchaser, if it's not fraudulent or that sort of thing, they just don't qualify for financing for whatever reason, the purchaser can back out of the contract upon showing that they've been denied and receive their deposit check back. If they go past the 45-day contingency period and do not notify the seller that they didn't qualify, unfortunately, the deposit then becomes property basically of the seller, and they can't back out of the deal. At that point, they either got to go forward, or if they can't close, the deposit will be given to the seller as liquidated damages. Home inspections are usually done when we're going to contracts. That's not really put into the contract initially. However, if there is some items that pop up during the inspection, whether it's a roof leak, electrical needs to be fixed, that sort of thing, one of two things usually happens. If it's a small thing, I would normally just draft what's called a repair rider, and it's a one-page document that goes at the end of the contract. Kind of does like a little punch list of what needs to be repaired with the house prior to closing. If it's something more substantial, like a roof needs to be replaced or repaired, or whatever the case may be, if it's a substantial amount of money, a lot of times it could be negotiated where the buyer will get a credit at closing for the amount that would normally cost to repair it. Once you go to contract, the next step will be to get title insurance. Title insurance basically is it insures your title. What is title exactly? It refers to a bundle of legal rights that come with ownership, and defects in title can impair your ability to use, sell, or borrow against the property in the future. So therefore, you get title insurance that protects you from any of that. It's a one-time fee. You pay the premium at closing. I would never recommend someone get or purchase property without it, because even if you don't get property insurance, or not property insurance, title insurance, and you go to sell it later on, it's going to raise a red flag for the next person, and you're going to have all kinds of issues. And it's just a one-time fee, and you can sleep well at night. If somebody does make a claim to title later on, saying it's their house and the deed wasn't properly recorded, or whatever the case may be, you're insured up to the value of the house at the time you purchased it. A lot of times I recommend clients purchase what's called a market value rider when they're at the closing. What this does, if there is a claim down at the time of the claim versus at the time of when you purchased it. So if your house significantly increases in value, you're protected up to that value. It's a very nominal fee, usually $150 to $200, depending on the title company, and it's worth every penny. You sleep well at night. Also, when you get title insurance, the title company is going to run what is known as a title search. What this does, it searches for any defects or liens that might be on the property. Also searches for building violations, open permits, taxes, mortgages, anything. And you kind of get a whole story of the house, who owns it, who owned it before them, and what's going on. Normally, you'll see that there's a mortgage on the property, maybe a judgment here or there, but normally this stuff can be addressed at closing with the seller's proceeds. Sometimes it can get, you can have a lot of building violations. If it's the city, especially, the ECB violations have to be paid off right away at closing. And you really can't close until you have clear title and all that stuff is addressed, especially if you're taking out a loan. The bank won't clear your loan until all these title defects have been addressed. So it's very important in that aspect that you get title insurance, and you really don't have a choice, because the bank's going to make you get it one way or the other. They actually will have their own policy as well as you, to protect their interest in the property in case you foreclose on the property. What else? Also, when you're going to contract, you're going to have a property condition disclosure, which up until recently, nobody really filled it out. You gave a $500 credit to the purchaser at closing, and that kind of covered it. Now what it is, it's a 50 some odd question survey about your property, asking it all kinds of questions from environmental, history of the property, oil tanks, flooding, anything you can imagine. What I tell my clients is, just don't lie. Don't lie on the form. Give the answer. You're required to give the answer that you know at the time you're filling it out. So you don't have to do research. You don't have to go through your records. If you know the answer when you're filling it out, great. If you don't, you don't. There's no right or wrong answer. Just don't lie, and you'll be fine. Otherwise, you're going to open yourself up to possible litigation down the road if something happens, which nobody wants that. Once the title insurance is cleared and you've gotten your clearance from the bank, we go to closing, which is, everyone builds it up to be some big thing, and then you sit down and it's over in an hour, and it's really not that crazy. But my job with the closing is to, speak with the seller. We kind of finalize the numbers. There'll be some adjustments made to the purchase price, depending on whether taxes were paid and if credits were given, that sort of thing. And then you come to a final number that the buyer owes the seller, and That's when everyone gets paid, the lawyers, the brokers, the seller, and anyone else that may be involved. And then at that point, you get your keys and you become a rightful homeowner. Just a couple other little items to discuss, when going to closing or when to setting up a closing and when you're in the contract, there's something called on or about date. You hear this a lot. It's a term that's used all the time in contracts for real estate. What it means is, let's say we're signing a contract, we have on or about date 30 days from the signing of the contract. You don't actually have to close in 30 days from the date of the contract. That is just it's kind of a baseline date. You do have to close 30 days from the on or about date. If you don't close from 30 days from that date, seller's attorney is going to send you what is called a time of the essence letter. Usually it's 14 days out. And then if you do not close on the 14th day, the sale is null and void. They can put the house back on the market and they can keep your deposits. So keep that in mind when you're applying with the bank. You have to move things along. We can't sit on things because there's a lot of deadlines you can blow and you'll be obligated to pay money that you didn't want to pay. So those are all my tips. Those are my the items in the contract and the kind of the process legally and what happens when purchasing a home. I'm gonna pass it over to I believe Nick or Jared. I'm not sure who's going next.
Yep, it's me.
Right.
Everybody, my name is Jared DeCandia. I am a financial representative at a financial advising firm, Forest Hills Financial Group. I'll talk a little bit about our firm in a bit. I'm also going to be presenting along with my colleague Nick, who will be following my speaking. And so our job today is to give you sort of a financial planning lens on strategies to help you when you're in the process of selling your home. So when we're talking about this kind of situation, we're talking about essentially an infusion of capital, onto your financial landscape, into your situation, right? So if you're going to be selling your home and then buying another home of equal or greater value, then this particular conversation may not relate to you. But especially if you're going to be getting proceeds from this sale and keeping it, whether you're downsizing, right? Maybe you have $1 million home, you're downsizing to a $600,000 home, perhaps. What do you do with that $400,000? Or, as we see a lot of times, people just already have a main property and there's another property maybe they inherited, or for whatever reason, it doesn't make sense to keep it or rent it out and they want to sell it and keep those proceeds. So we're really helping you to understand how to manage a large amount of money, because if you don't know how to manage a little bit of money, then you're likely not going to know how to manage a larger amount of money. Just ask anybody who's ever won the lotto. So I want to sort of get into some of the ways that we help our clients. So I'm going to share my screen briefly. Give me 1 second. And so, this is essentially the balance sheet, right, for someone in their life. And what you do with an infusion of cash, however much it is going to be a really important question. Are you going to use that wisely? There's so many things and there's so many strategies that you can use. If you just let it sit in the bank, that's not one of the better strategies that you can use. So we're going to talk a little bit about it. And so I'm going to be giving you a little bit more of a high level perspective of how we might help our clients in this situation. And Nick is going to get into a few more specifics. And so, what's really important about understanding how to help someone is just understanding who they are and what their goals are. So every time we sit down with a client, the first thing we're going to do is share our philosophy, which is what I'm going to share with you all in just a moment. And then we understand what their goals are. And I don't mean necessarily how much money they have in the bank account, but really what are they hoping to achieve with that money? What are the qualitative goals that they have in their life, whether it's retirement or travel, lifestyle, whatever it is, right? And then the other thing that we're going to have to understand to be able to make good recommendations is key data, right? So what is their current financial situation like? So once we know their current situation, and we also know where they want to be eventually, which is their goals, then we're in a really good place to help them with some recommendations. And so we always want to understand a little bit more about their experience and also share more about our experience too. So, Forest Hills Financial Group has been around for over 40 years. We started in 1980. We are in the Guardian Network, which is one of the oldest mutual life insurance companies in the country. And we also have a broker dealer, Park Avenue Securities, which is going to help with all of the securities or investing needs that we have as well. And so we're about 100 advisors in the New York metropolitan area, although we have an influence over the entire country. And we have about 40,000 clients that we've helped with. And over this time, you know, these 40,000 clients, we've helped them. Each of them is an individual. Each of them has a different situation. And what we found is that everybody's different. When you talk about planning, there are many variables, and variables are things that you can't always predict. You don't know how things are going to go. Whether it's financial planning or any planning in general, you have to always be ready for the unexpected. And so what you can see here on the screen, these are some of the things that people consider or people worry about. Maybe it keeps them up at night. I don't know. But these are a lot of the things that people can't predict. And a lot of people in the financial industry and financial services are going to make entire strategies and tactics focused on some of these things. But, you know, we really just don't agree with that because just as in life, also in financial planning, you really want to focus on the things that you can control. And if you notice these things here on the screen, a lot of these things we don't have control over, right? So we really want to start from a place where we can actually make a difference. There's things that we can actually control. There's two things here that I really want to bring up quickly: protection and cash flow. And when you see these two things are sort of the realm in which you really do have control over. And I want you to think about these two things as two different parts of the main strategies, right? Or the main categories in financial planning. One is going to be defense and one is going to be offense. And I kind of always think about sort of the wars once upon a time where people will go out with a sword and a shield. Imagine if you went out into the field to fight and you only had a sword or you only had a shield. You wouldn't feel very comfortable, right? So whether it's, you know, sports or whether it's war or whether it's financial planning, you want to have a solid offense and defense. So today we're going to talk a little bit about defensive strategies. We could make tons of other webinars about other growth strategies, but today we'll focus more on protection. And so, you know, protection and cash flow, you know, these are the things that are going to make your balance sheet more holistic. And this kind of brings us back to sort of what you saw in the beginning here. I want to talk a little bit about just what it means to protect yourself. And this is a few of the things that we bring our clients through, a few of the things that are sort of basic in terms of learning how to protect yourself and sort of insulate yourself from the variables that you can't control. There's a lot of things on this list here. All of these things are going to be important to help mitigate some kind of risk. And, you know, we can make a seminar on each one of these things. Today, there are two things that we want to talk to you about specifically. One of them is going to be long-term care, and one of them is going to be life insurance. So again, we're speaking more about the protective side and especially how to protect your assets, right? Especially if you get more income or more cash from a home sale. So, you know, one of the things about long-term care insurance is interesting that you may not know, it's sort of a frightening statistic, is that over the age of 65, 2 out of 3 people, should they live past 65 well into their retirement, are going to need long-term care. That's a very high percentage, and long-term care is very expensive. You know, whether it's the entire country, the average, right? We're talking about almost $100,000 easily. If you're looking at New York, it's going to be well above that, right? And if you're going to ever need maybe assisted living or a nursing home, this could be well above $15,000 a month. And the problem here is that usually is funded by somebody's retirement, somebody's nest egg. And, you know, maybe if it's just you, you can burn through that. But if you have spouse, if you have kids, if you have any other dependents, it could be a problem that you're going to burn through this. And so, you know, having a plan for long-term care, which Nick is going to share a little bit about in a little bit, is going to be really important, right? Something for long-term care. The other thing is life insurance, right? I want to speak a little bit about this from an educational perspective. So there are two types of life insurance, generally speaking. The first is what we call term life, which is just the really basic kind of life insurance that most people think about. And so this is, you know, the word term meaning a specific duration of time. So the term can be 10 years, 20 years, it could be 30 years. And essentially you're signing a contract with the insurance company that if you pass away during that term, let's say it's 20 years, then they will give you a tax-free, which is important to remember, a tax-free death benefit for whatever the face value of the policy is. Maybe it's 500,000 or 1 million. Sometimes it's way more than that, depending on the policy that a person can afford. But it's very basic here. You basically have to pass away during this term. And the other thing that's important to note is that the cost goes up. And that's because every year that you age, every birthday that you have, the cost for life insurance increases because, theoretically you're getting closer and closer to the other side. So that's one thing to keep in mind, is that the most affordable time in your life is when you're younger. And we also have policies that are level, but once that term is over, so let's say you get a 10-year term, once you're on your 11th year, the price is going to shoot up by 10 more years, and that's for a lot of people is going to be prohibitively expensive. And so that's just basic term. The other one is going to be a certain kind of permanent life insurance that we call whole life. So whole life is named such because it actually covers you for your whole life, your entire life, not just 10 or 20 years, but all the way through, which is a benefit that's going to be helpful for a lot of people, because when a term policy runs out, somebody's usually closer to retirement or well into their retirement years when you really could want that policy. The things to remember about whole life are that the cost, you can see the red line here, is higher than the term life, is more expensive, but once you lock in whatever your premium rate is, you keep that for the entire duration of the policy, which is usually your entire life. The other thing is that the death benefit can actually increase over time, because as you make your payments, you're actually building what's called cash value. So there's a savings component. This grows at a certain percentage year after year. It is not dependent on the market. So unlike what happens with your investments when there's bad news in the world, this is the kind of asset that continues to grow. And so, we bring up whole life because for a lot of people, this is going to be the key to them preserving their assets, right? So we're talking about preservation of assets. And I'm going to hand it over to Nick in just a second. But, the two little strategies, right? Because there's a lot of things we could talk about when we talk about protection that I mentioned today. One is long-term care, and one is life insurance, whether it's term or whether it's a permanent life insurance policy like whole life. And one thing that I want to leave you as you transition to Nick is that you could get a long-term care policy. There's some ones that are affordable, there are some that are expensive, but there's a unique kind of asset that you can get for yourself that is somewhat of a combination of the two. And Nick is going to get into a little bit more of the benefits and what that means for specific scenarios and how that could help you. But to be able to have the benefits of a whole life policy with a long-term care rider on top of that is going to be a very strong way for someone to protect themselves into their retirement, throughout their life, protecting their legacy, protecting their loved ones, and also having benefits for them to also access, in addition to whatever they saved up for their retirement. So I'm going to hand this over to Nick. I'm going to stop sharing my screen, and I'll leave you with that.
All right. Good evening, ladies and gentlemen. My name is Nicholas Varelli. As Jared already explained, we're from Forest Hills Financial Group. He gave you the high-level background of our firm, what we do, and how we can help you with protection of assets and preservation of assets. So I'm just going to do a little bit of a deep dive on a scenario that could potentially happen, like Jared had said, that happens to about 2/3 of Americans. And we're gonna get into the details on how we can help protect these things going forward. All right, so let me just bring up my screen right here. All right, so this is a real basic fictitious client that we made up for you guys, just to give you a high level overview of how this protection could really come into play and with certain events that are going to happen in life. So just a quick, assumptions that we have 500,000 in retirement. The home value you currently have is $1 million. We got a little bit left on the mortgage. The taxes over here come from the repercussions of your retirement, of it being a non-taxable taxable account. Other than that, it's pretty basic stuff: savings accounts, investment accounts. And this is really more of an emphasis on the protection side. So we'll get into some of the scenarios we built out for you guys over here. So once this loads. course, it's going to take forever. Okay, so we're just going to focus right now on the green checked boxes over here. Okay, so we have your income, $120,000 a year, your expenses outflow, $108,000 a year, which means you're saving about $12,000 a year. It's 10% of your income. That's pretty much an average home. That's what you're going to see. Then we jump into what your retirement income will be. That's going to start years 11 through 35, while your regular income is only years 1 through 10, because then you'll be retiring around 65. This is John. John has a wife. He has some kids. So he'd like to leave something of his legacy to the people that he loves, right? So we have the sale of the home, which is what you guys are going to be focusing on, in this time period. And then the downsized home purchase. So he's going to sell his $1 million home. He's going to switch over to downsize to maybe a little high ranch or something, maybe less stairs in his life so he can keep it safer. He's going to protect his body, right? This one, he's going to be protecting his finances. So $650,000 for the new home. And what I'm going to illustrate right now for you is the different things that could potentially happen if you do come into a scenario where you're going to need long-term care. So this is year 1, this is year 35. Over these events over the year, if God forbid nothing happens, you're going to end off with $2 million. That's going to be left for your wife, your kids, whoever's going to be part of your legacy, right? What we're going to get into over here, right? So disabled long-term care. See the OOP, that's out of pocket. We call that an oopsies. I didn't buy whole life with a long-term care, so I made a little bit of an oopsie. And what's that going to cost you, right? So we'll look at the cheapest option first. The cheapest option is usually not the best care, right? Cheapest option, it'll illustrate here that in year 34, 35, when you're about 90 years old or so, you're going to run out of money. Now, what do you do to figure out how to pay for it once you're done? That's something you're going to have to turn to your kids, turn to someone in the family that's going to have to help you out, because you can't take another income or a loan on your income once you're in retirement, because you really don't have any income to take a loan on, right? So we're going to call it a disabled LTC with an oopsie on the expensive end. This is what you're going to look at for your expensive end. You're going to run out in year 30. So you really only have a couple of years, and you're going to have to figure out roughly $2 million worth of cash to come up with just to get yourself to that life expectancy. So now we're going to jump into disabled with a long-term care policy. This one's going to be the biggest one, because if you get a whole life policy with us with a proper long-term care involved, it's going to bring you to that 1955. So you're going to spend a little bit while you're in it, to pay for the policy, to pay for whatever you need. But when it kicks in and it's readily available to you, you're sitting right around that same. If we go back to that original illustration I drew up, you're sitting around, if God forbid nothing happens, you live a happy, healthy life, you die at 90 years old, you had a long life, very prosperous, you're sitting around $2,025,000. Now, I showed you either of these long-term care options where you had to pay out of pocket, the oopsies. You're going to go into the red pretty early on, within 10 years of you being into that situation. So this is going to illustrate for you what's going to happen if you have a proper long-term care policy in place, right? So you have the 1955 versus the 2,025,000. So it's really only a $70,000 difference in your total asset value of what you'll be able to hand down as your legacy, just by taking the right steps now and getting yourself into a proper protection setup. Now that's also not factoring in what happens when you pass away and you have the policy kick in as well. So now once the policy kicks in, you're sitting at 2.5 million. 2.5 million a lot of the times is a lot better for most of these people when they want to talk about, do you have a legacy to pass down? Or if you had to pay completely out of pocket and you ran out of money and your kids had to start taking care of you. The extra stress that adds on a family of having to figure out who's going to take care, who's taking the doctors, who's doing this, who's doing that. The long-term care policy will cut all of that out. It's going to take care of if you need rides to the doctor. It's going to take care of whatever kind of housing you need. If you want to keep your home, live in the home, and have in-home nursing, you have that option. The options are endless with this. The biggest emphasis on this is that if you were to run into one of these situations and you run out of money, you're going to have a bad situation where, you're scrambling, your family's scrambling, whoever is scrambling, they're going to have a bad situation. So We set up these policies with people so in the long term they can live a proper, happy, healthy life, and they can really be prosperous with it. You know, they could stay comfortable in their own home. They can have a live-in nurse of their choice. They could do whatever they want. They have the freedom to do whatever they want. No one wants to work their entire life just to end up having to live under someone else's reign or rule or decisions for the last 10 years of their life just because they didn't set up a couple of things early on. So we really put the emphasis on that. And then not only that, but I'd like to also add in that the permanent insurance policy will also cover, you know, God forbid if there's any mortgage left over or anything like that. And, you know, in the case of an event of someone passing away in the due time, your spouse will be able to take care of the mortgage and everything and then some. It'll also cover funeral expenses. Any final expenses will completely be paid for. So that's really our biggest emphasis when we're talking about the long-term care, the whole life portion, and how we could seriously protect your assets and protect your future income as well. You know, we don't want a situation where, you know, your wife has to go back to work at, you know, 70 years old, 75 years old, because we didn't have the proper thing set up. So that's one thing that we're going to sit down and really go through, and we're going to find out what you need, what's right for you, the right situation, and we can build it and tailor it around you. I believe that's really it that I have for today. I think this illustrates, you know, the need for protection in someone's life.
All right, thank you, Nick. I guess right now the panelists, if you can all turn on your cameras, and if Nick, you can unshare. We have a couple questions that just came in. Excuse me. So the first question that I have, excuse me, is for Anthony. What are some of the most common legal surprises sellers face currently?
Been seeing a lot of outstanding building permits and violations that need to be addressed. You know, you get people that they buy a house, they do some work to it, they say, I'm not gonna get the permits, we're never gonna sell. 15 years later, they go to sell, they have an open permit or they have an open violation or something spotted that they didn't get permits for, and now they gotta go ahead and get their permits in order. And that can delay closing by months, depending on, you know, whether it was even done to code. If you need a variance and that sort of thing, it could delay things even further. So that's the biggest thing I've been dealing with on a regular basis, frankly, the past couple months.
Okay, I have another one for Anthony. Just reading the screen.
Evans, I'm blocked on the video for the host.
Hello?
Sorry, if someone is buying and selling at the same time, this is for you, Anthony.
All
Someone
right.
is selling and buying at the same time. Um, what are the legal risks that they should watch out for?
Buying and selling at the same time, got to make sure that you have if you're borrowing, you got to make sure you have your money in order, as well as you know you got to make sure your timing is correct. Ideally, you want to close on both at the same day. Does that ever happen? Not really. It's very tough to do that. Um, got to make sure that you got your finances lined up before you go sell. Ideally, if you can handle two mortgages at once, or you can finagle a way where you buy one house and then you don't have to, usually when you buy a house, you don't make a mortgage payment the next month. It usually be the month after. And then you could sell your house that you're trying to sell afterwards. You can make it where you're only paying one mortgage, even though you've got two mortgages on your record, and then you really don't feel it. So that's, I guess timing is the biggest concern when buying and selling your house, making sure all that's in order.
All right, thank you, Anthony. Dean, I have a question for you. If you can unmute yourself. So the question that we have here is, what is one small upgrade that brings big return when listing a home?
One small upgrade, there's quite a few upgrades, but one small upgrade, a nice roof on the home People don't always think about that, but every single buyer, when they come into the home, they ask how old the roof is. It would be one of the first 1 or 2 questions or 3 questions that they ask. The other is an obvious one. If we're not going, to small upgrade, painting the living room, painting the home. And the next one, if it's a mid-size upgrade for any reason, it's a kitchen, being a modern kitchen, for sure.
I'll add a little bit onto that one. Lighting, putting the perfect lighting into the house basically just makes the house look much brighter. It looks lived in. People want to see everything, so put better lighting into in the homes as well. Fernando, we have one for you. Can someone get approved for their next mortgage before selling their home on the current home?
Yeah, definitely. Prior to the question that they give it to Anthony, they need to know if for the next purchase, they're gonna need the cash that they are getting for the sale of the property. Okay. But for example, you are planning to sell the house, I can pre-qualify you because if you are selling the house, I'm gonna consider that that liability is gonna be off, and then your entire income is gonna be towards the new purchase. We can do that. We do that all day long. I mean, a lot of people sell and buy. And we do, I mean, if I don't handle the 2 transactions, a lot of times I do it, like Anthony say, we close, one day and the next day, we do the other transaction. You can do that, but get price qualified is not a problem. It's not a problem.
All right, the next question kind of dovetails into this. Could you walk us through a deal that's a bridge loan and if it makes sense for that particular seller buyer?
It's too expensive. 2 closings, it's too expensive for that because you're gonna be doing 2 closings, and the long way, the best way is just close on the sale and then do the purchase.
Okay, thank you. For our Jared and Nick, we have a question. What's the smartest thing a homeowner can do? What's the smartest thing a homeowner can do with their equity after selling?
A good question. There's a lot of factors that are really going to determine that answer. So as always, it depends, right? We shared stuff today from the protection perspective. There's also a lot on the investing perspective. But I think what you need is someone to look at your current situation, your current goals, see what kind of assets you already do have. If you don't have many assets, then the strategy is going to be different than if you do have a lot of assets. Maybe you do have a lot of capital, right? You have access to. So it really, like, the best move is going to be anything that's going to, kind of give you a better life. And that could be protection depending on what your balance sheet looks like, but it could also be investing. I don't know, Nick, if you want to add something to that.
Yeah, so I think one of the big things that comes in here is different ways to do it in a tax sheltered way. So maybe not taking all of the proceeds and putting it towards, the new home. There's stuff left over. There's obviously going to be a profit there. Now, what do we do with the profit to put it into a better tax sheltered way? So at the end of the year, you don't have a massive tax liability, and that's something that we would have to look on a situation by situation basis. But it's something we do all the time.
All right, so I'm looking at another question that just came up. What role does insurance or estate planning play for a seller's long-term strategy? You kind of answered some of that, but just in case they might have missed that, if either one of you want to take that.
Yeah, I think strategies to protect your assets is a big thing. Unfortunately, it is a very common situation in this country that people did not prepare well for their retirement. And so they don't have the ability to stop working or even to work less. And so you want to make sure, right? Because if you think about insurance, like from a life insurance perspective, it's, what if you pass away too soon? But, something like an annuity, for example, is the problem is, like, what if you live too long, right? And you outlive your money. So there's going to be, again, it's going to depend on a lot of different factors. But I think protection needs to be an integral part of your plan. I've met a lot of people that we have done some planning with, and they have investments, they've grown their savings, but they are not prepared for, the risks that could happen. And it's interesting because if you look at the odds of some of these risks, like dying too young or being disabled or, being sued, the risk of any of these on their own may not seem scary, but the odds of at least one of these happening to you tend to become pretty high. So you really need a plan. And there's all these different kinds of insurance: life insurance, disability insurance, long-term care insurance, auto insurance, umbrella insurance. So it's really going to depend on where your gaps are.
All right, I think that's about all the questions that we have right now. I just want to thank the panel for the time and for the expertise to share here with our audience. The next step for you guys to do who are watching this, and you'll be watching this later on as well, is to pick up that phone, make that phone call. You have more questions, do not be shy. Maybe you don't want to answer, have them answered right now and you want to do them privately. You can always reach out to either one of us regarding any topic, and we can go over basically what's pertinent to you. So I'm gonna start with Dean. Dean, could you give them your phone number and how they can reach you when any real estate related questions? Take yourself off mute.
Sure. My phone is 516-527-9549. And I hold it up because it's kind of always in my hand. I'm easy to get in touch with. Or you can email me. It's my name, Dean Graber, Graber @kw.com. Look forward to hearing from you.
And I'm his business partner, so we both handle real estate. Real estate is all we do, 24/7. Pretty much it's actually, if there were more hours in the day, that's all we do pretty much. But any questions regarding selling a property, relocating, any of those things, feel free to reach out. My number is 917-975-5985, 917-975-5985. Our website is mynyhomesales.com. You can find this video and everything else on that website. Also on our social media, look for Evantz Sells Homes on all social media platforms. That's where you'll find all our content like this. And our next up is Anthony. Could you tell them how they can reach out to you? Take yourself off mute, please.
Sure. They can reach me at my office, 516-809-8483. Or you can call my cell or text my cell. I'm very responsive. Again, like how Evans and Dean live real estate, so do I. So you can text me or call me, 631-943-8351, or you can shoot me an email, Curcio at curciolawpllc.com. You can also check me out on Instagram, my website, curciolawpllc.com. And yeah, that's it.
And next up, Mr. Fernando. Senor Fernando. Please take yourself off.
Okay, yes, guys, you can reach me always in my cell. This is my partner all the time. I always pick up the phone call. If not, I back to you in shortly by text, but I'm always available. I work, with my computer and my phone is with me all the time, even on vacation. My cell number is 917-418-9402. Again, 917-418-9402. Also, you can email me, shoot me an email, frlopez@unitedmortgage.com. frlopez@unitedmortgage.com. I'm always available, guys. You can text me or you can call me, and I return, text and phone calls right away.
Thank you, Fernando. Next up, Jared.
Yeah, so I think my cell phone is the easiest way to reach me. That's 718-962-4037. You can also shoot me an email. So it's my name as one word with a period in the middle. So it's jared.decandia, one word. You can see my name here, right? So jared.decandia@fhfg.com.
And last but not least, our closer.
Yeah, so Nicholas Varelli, you can find me at nicholas.varelli@fhfg.com. But personally, I'd rather you call me at my personal cell, 631-885-2741. That thing does not leave my side, just like Fernando and the rest of the guys here, at all times, whether I'm on vacation, I could be halfway around the world, I'm still answering that phone. So if that's definitely the best place to give me a call.
All right, thank you, gentlemen. So with it being said, we've said pretty much all the things that what we specialize in and things of that nature. So you've been watching from listings to lasting wealth, real estate, and financial strategy for sellers. I'm Evan St. Gerard. I just want to say thank you for watching. Now your next step, I'm going to share the screen with our contact information. So don't hang up just yet. Just give me a second. So our contact info is on the screen. Hopefully you can see it. So feel free to reach out to us if you have any questions regarding real estate, financial, loan, mortgage questions.